Siddharth Khemka is also with us on the show. Siddharth, hi, good to be speaking with you. What do you make of the market setup right now? Do you think the bulk of the poison is out of the system, or do you think there's going to be another couple of weeks of volatility, and it's only perhaps at the end of next week, after that Delhi election outcome, etc., is out, that the market will finally stabilize and pick up a direction?
Anisha, I think if you look at the major worry for us from the market perspective is the earnings, and that has been something which has been a bit subdued, and only I would say only until the end of the result season we could see some stability based on whatever numbers that have come so far and the outlook for Q4. Even Q4 doesn't look to be a very strong quarter. For this quarter, our expectation was about 5 to 6% Nifty earnings growth, and for the full year FY25, again, there is a earnings expectation of about growth of about 5 to 6%. So Q4 could see even a lower number in terms of Y-on-Y growth. I think that until that is gone, market could remain in a consolidation mode. There is a big event of budget over the weekend, and then we have the RBI meeting followed by the Delhi state election. So a lot of events are lined up, which will only induce volatility in the short term. Markets have corrected almost about 13% from the top. We see some semblance coming back, especially in some of the large cap names, which we prefer in this volatile environment. Also, based on the announcements that the government could do in the budget, several sectors linked to the economy, core industrial economy, that could be in focus from a near-term perspective. Having said that, from a medium-term perspective, we believe this year we could see some of the themes linked to the export recovery, export revival, for example, pharma, IT, that could do well. Demand has been pretty strong for improving trend that we are seeing in the technology space, especially from the US, where the interest rate cut has happened, and the new administration is also talking about the income tax cut. So that could also support discretionary spendings on the tech front. That should be positive. Pharma is another space that is looking better in terms of earnings growth. This would be the fifth or sixth consecutive quarter of strong earnings growth from the pharma space, healthcare space, and I think not only the domestic business is doing well, even the key exports market of US, Europe, there we are seeing sanity coming back, realizations improving, demand coming back, and hence the kind of good recovery that we are seeing in these pockets.
That's about the pockets that are looking good, given the fact that you have that big important event also near the end of the week. It's a Saturday, February 1st. You have the union budget. A lot of sectors to watch out for, and Siddharth did highlight a couple of the sectors that we have to watch out for on back of that. Also, Siddharth, I wanted to get your view coming in on the life insurance companies in particular, because given the fact that you have a lot of murmurs, a lot of chatter on the fact that there could be some rationalization or some rejig being done in the income tax slab. So on back of that, what's your take when you talk about this life insurance companies, given the fact the government has been pushing for a lot of them to shift to the new tax regime as well?
Think there was a lot of hopes around earlier with the GST Council meeting that the tax on insurance would be brought down. That has not happened. And this time around, there is again a lot of chatter that we are hearing that the government should increase the exemption limit under Section 80C, which has not been changed for past several years. So if that were to happen, and as you rightly highlighted in the old regime, because the new regime doesn't have any of these clauses of ATC, I think there could be a case where the government could increase marginally the exemption limit in the ATC from about 1.5 lakhs to 2 lakhs. That could incentivize more savings in this environment. But clearly, the government looks focused to shift gradually to the new regime where you have a blanket rate and there is no sub segments or sub exemptions clauses. So it's a difficult call. Jan, Feb, March, JFM, as we say, is a big month for insurance. So I would believe that if it doesn't come, there is not much negative. But if it comes, it could be a big positive for the insurance companies, especially in the JFM period.
So that's the take coming in the space. But let's talk about the cement sector, especially Ambuja Cements, because it's come out with their Q3 earnings. We have the whole-time director and CEO Ajay Kapoor helping us break down numbers for Ambuja Cements in the quarter gone by.
I'm delighted to present Ambuja Cement's strong financial performance for Q3 FY25. Ambuja Cements has delivered steady performance, supported by cost leadership, improved efficiencies, and growth. For the Q3 YOY, the consolidated performance, our revenues were up at 9,329 crores, operating cost at rupees 4,618 per ton. This is mainly on account of the reduction in energy and freight and forwarding costs by 7%, driven by our efficient fuel management and strong focus on green power. We achieved a 10% reduction in kiln fuel, now at rupees 1.66 from the previous rupees 1.84 per 1000 kilocalories. Our green power share has gone up from 15.8 to 21.5%. The freight and forwarding costs have gone down by 6% from rupees 1,322 to rupees 1,239 per ton. With these improvements in cost, our EBITDA is rupees 1,712 crores. The EBITDA per ton now stands at rupees 1,038 and margin at 18.4%. The PAT stands at rupees 2,620 crores. Our consolidated cash and cash equivalent at the end of 31st December 24 remains at rupees 8,755 crores. On a standalone basis, net revenues at rupees 5,043 crores with a 24% volume increment at 10.1 million tons. Our EBITDA is rupees 601 crores. EBITDA per ton is at 595 and margin at 11.9%. PAT of rupees 1,758 crores. Coming to strategic investments and expansion, our current capacity is at 89 million tons, and with ongoing expansions and post-successful completion of Orient Cement transaction, our capacity will reach 104 million tons by Q4 FY25. Our capacity will further go up to 118 million tons by FY26, reflecting an increase of 51 million tons, which is 76% growth in 3.5 years after becoming an integral part of Adani Group. Our acquired assets enhance efficiency, resource utilization, and sustainability. With an expanded footprint across peninsular India, captive jetties, and more bulk cement terminals, we have strengthened our marine logistics. Digital innovation and reducing lead distances will reduce logistics cost and emissions. We have commissioned 200 megawatt of solar power in Khavda, which will further reduce our power cost. Our goal is to reach 1 gigawatt of RE, including wind and solar, with an investment of rupees 10,000 crores.
Okay, so that's the latest coming in from Ambuja Cements. But Siddharth, what's your take as far as cement as a pack? In fact, before I come to you, Siddharth, let me take it across to Shrikant to get his sense. Shrikant, on the charts of the cement companies, which are the ones that look better to you?
Yeah, I think, see, like in this particular space or basket, we like Ramco Cement, we like Ultratech Cement. Both the stocks are showing a lot of strength. In fact, Ambuja is like it's still finding a lot of difficulties to sustain at higher levels. So we may see some more consolidation in the near term. But Ultratech Cement, based on technical, looks really strong. It is like forming a higher top, higher bottom series, and it has been like consolidating since last almost 7-8 months. But based on its technical formation, I am of the view that the stock is on the verge of crossing 12,000, 12,100 levels. We also like Ramco Cement, where the stock is currently quoting at 927, and based on its long-term technical pattern, it is forming some bullish continuation formation. And there also I'm expecting stock to move towards 1040 or maybe 1100. So both these stocks are really showing a lot of strength on charts. In fact, the entire space is doing well, but few of them are really good.
The cement space when it comes on the chart. Siddharth, let me come to you and ask you the question on cement space, given the fact that quite a lot of consolidation is already at work in that particular space. You have reports suggesting that Ultratech also is looking at another company now to acquire. What's your sense in the cement pack, and where will the leadership emerge? Because you have these two groups that are actually eyeing a huge share of the pie.
Lot of consolidation has happened both in terms of the industry as well as in terms of the demand. We are now seeing Ultratech that announced its numbers last week, and now JK Cement 2 days back. We are seeing volume growth returning, and that's a good sign. The only thing is realizations are still not up, and we have heard news flows in the month of December that most of the companies have started taking price hikes in the range of 10 to 15 rupees per bag. So what again we are witnessing is that there are signs of recovery in the cement demand across sectors, be it housing, be it infrastructure, and both rural as well as urban. Plus a good monsoon that is estimated to drive demand, especially from the rural sector. And we have the upcoming budget where again this year the government spending has been low, but there are expectations that the government will now go and overdrive next year and should target about 10 to 15% growth in their capex spending, which should also be positive for the overall cement space. Now, coming to preferred ideas, we definitely like Ultratech, which is our preferred pick. They have reported very strong numbers, and we also expect improvement in profitability in Q4, largely led by cost savings. So it's a market leader and consistently doing well. We expect a revenue CAGR of almost 18% and PAT CAGR of 32% in Ultratech, which is our preferred pick. We have a buy rating and a target price of 13,800. The second stock that we like is the mid-cap space, JK Cement. The company also delivered strong, healthy operating performance. Volume was good. The company has a good mix of grey as well as white cement. And within the, you can say the tier 2 kind of cement companies, JK Cement remains one of our preferred ideas. It is consistently gaining market share in the premium products. Plus, we are expecting 8 to 10% volume growth in the fourth quarter and about 10% volume growth in FY26 for JK Cement. Again, we have a buy rating and a target price of 5,630 for JK Cement.
Point taken. That's the take coming in as far as cement pack is concerned. But some of these new age tech companies are clearly bouncing back today. Zomato is showing quite a bit of strength. There's Paytm, which is doing quite well in the trading session. Finally, some of these names are finally getting out of the woods. Kunal, on the charts, is there meaningful strength in these names, or there are other pockets which look better?
No, I think there are other pockets which are looking better because, for example, Zomato, even if the stock is up some 6-7% today, the volumes are almost at stagnant to the volumes over the last 2-3 days when the price was going through a sharp correction. Generally we, if we expect the stock to get into a counter rally, the volumes have to be almost 2x, at least 1.5 to 2x of the volumes or the average over the last 3 or 4 days when the prices go into a selling spree. So if that doesn't happen, which means we expect that the stock price recovery, even if it happens on a higher magnitude of price scales, may not be sustainable, and you might eventually see these stocks going to a correction. So I think that's why I think one needs to concentrate on stocks which are moving up specifically on the back of higher volumes.
All right, so that's the strategy that you should adopt when you talk about investing in markets at this point in time. But Kunal, before we wind down for trade today, wanted to know what's your BTST idea for our viewers?
So two buy calls. Manappuram Finance is looking extremely attractive. The stock breaking past about the series of resistances around the 195 to 200 range, crossing 200 moving average, as well as on the back of much higher volumes. So we'll look out for 206 as an immediate target, revising the stop loss to 195. And the second would be a buy on Bank of India. 3 successive days of very strong price gain for Bank of India, and the stock is now on the verge of breaking above its 200 DMA. 118 could be a near-term target. Stop us at 105.
Okay, Shrikant, what about your BTST trade ideas?
If we go through with few sectors from the apart from this particular BFSI space, then we like in that Hindalco, which is currently trading around some 586, 587 levels. From here, the stock can move to the next levels of maybe 605, 610. So Hindalco at current level is a buy with a stop loss close to 578. We also like a few railway companies and stocks which are like belongs to railway sector. Most of these stocks are forming higher bottom as well as they are crossing their immediate highest level. So based on that, RVNL at current level looks promising bet, which is around 428, 429. Here I'm expecting target of 450 and we can keep stop loss somewhere close to 418. So I think the risk reward ratio is quite favorable.
That's the take coming in on the BTST ideas coming in from Shrikant as well. Lastly, actually, before we wind out, Siddharth, I wanted a quick view from you on the fertilizer space. How is it looking in anticipation or while we are heading towards the budget?
Yeah, I think fertilizers generally buzz before the budget in anticipation that the government could look at increasing the subsidy allocation, plus any increase in allocation towards the rural farm sector that is also taken as a positive for the fertilizer sector. On its own, I think they have done well in the last few years. And a good monsoon has also helped the space. What we like within the fertilizer space, Coromandel International is something that we like and is our preferred pick. You have a lot of PSU companies, for example, RCF, FACT. However, they are not in coverage as of now.
Okay, so that's the take coming in. The fertilizer stock, of course, they have been going through a huge downtrend. In fact, the entire chemical space, to be honest, the industry has been seeing a bit of a cyclical, down cycle, but hopefully out of the woods. Last 1.5 minutes left. So on that note, we'll thank all our guests for joining us on the show, Siddharth, Shrikant, as well as Kunal.